Might have to start dancing. All right. We are now live. So, hello and welcome to anyone joining us a bit early. Ken and I are having a little party here in the Zoom call. We will be getting started on time in just a few short minutes at 12:25 p.m. Eastern Time. Thanks for your patience. If you are looking for something to do while you wait, scroll on down to KRI's virtual booth. It's right below the video player. They do have some downloads available for you if you're interested, getting some more information. Hello again, and welcome to those who are just joining. This is your Money Show host, just popping in once more to let you know that the next session will begin on time in just a couple of minutes now at 12:25 p.m. Eastern Time. Looking for something to do while you wait? Scroll on down to KRI's virtual booth. It's right below the video player. You can check out their handouts there, download any if you want some more information. And of course, as always, you can reach out to the team to ask questions or request some more information if that's what you'd like. All right. Without further ado, let's begin. Hello, everyone, and welcome. It's my pleasure to introduce Ken Yee, the founder and managing member of KRI Partners. Now, Ken is a CPA and licensed real estate broker with over 23 years of significant real estate, banking, private equity transaction, and principal investing experience. Now, to our live viewers, if you have questions throughout this session, please share them in the chat box. It's to the right-hand side of the video player. And with that all said, Ken, I will hand the mic on over to you. I'll be right here if you need me, but the floor is all yours.
Thank you very much, Charlotte. Thank you so much for the great intro. Welcome, everybody. My name is Ken Gee. I'm the founder and managing member here at KRI. I am also a former CPA and former commercial lender. My story very quickly, I grew up in Toledo, Ohio, got my undergrad from the University of Toledo, moved to Cleveland, went to Case Western Reserve University at night for my master's degree while I was that commercial lender. Then I spent 7 years at Deloitte as the CPA doing a ton of private equity work, tax planning, merger and acquisition, due diligence, all that kind of fun stuff. If you could do any fun things as a CPA. It was there, though, that I decided that I realized my family was going to grow up without me because I was working way, way, way too much. And it really was going to be difficult for me to live the life I wanted to. So I got into multifamily real estate. That was a very, very long time ago, many, many moons ago. Had much more hair back then. Fast forward, here I sit today. We have a full-fledged private equity firm that I'm super proud of, and I'm really excited to be here today to talk to you about what we're doing and how we do it. So with that, let me get my act together here, share my screen, and we'll get started. All right. There we go. It looks like my screen is shared. All right, fantastic. So let's get through the legal stuff. Please note, investing in real estate does involve a high degree of risk and could potentially have risk all or some of your principal. This presentation is not an offer to buy or sell any security. That can only be done through our legal documents that are available in our booth. Finally, please note that nothing in this presentation should be interpreted as legal advice, tax advice, financial advice. Before you make any investment decision, make sure you consult your own financial advisor. All right, let me start off by just telling you how we make money in real estate. This is really important stuff. It's cash flow, appreciation, tax benefits. Let me roll through each one of these. So in our properties, we have a whole lot of people that work for a whole lot of employers in probably a lot of different industries paying us rent. That's a revenue stream that I love because it's super diversified and usually relatively stable. On the expense side, the expenses are pretty predictable. So as long as we get the management right, it generates positive cash flow. That cash flow gets paid to you as the investor. So that's the cash flow piece of it. The real story here with multifamily is the appreciation. Now, everybody knows single family homes generally go up in value, right? Everybody knows real estate goes up in value over time. In the single family home market, the value is determined based on whatever your neighbor happened to sell his or her property for. That's not how it works in multifamily, and that's why I love it. Multifamily properties appreciate over time when we're able to increase the net cash flow over time, just like any other business. You make it more profitable, somebody's probably going to be willing to pay you more for that. So in our world, we always plan to increase cash flow through some sort of value add strategy, either physical improvements or management improvements or some combination of both of those. Appreciation is where the money is in multifamily. It's not the cash flow as most people think. Um, Tax benefits. The big beautiful bill really cemented a number of our tax benefits. The good news is the IRS Lake allows you to take depreciation deductions on a property that's actually increasing in value. It doesn't have to go down in value in order to take those deductions. The losses that are generated in the tax world they do flow through to your personal return. You may be able to use that to offset other income. The good news is the cash flow that we distribute to you is generally not taxed currently. Now, on the sell side, when we do sell, you're probably going to get capital gains treatment for most of that. And in certain situations, you could defer the gain almost forever if you keep trading up under what's called a Section 1031 like-kind exchange. This is kind of the taxable income formula. It's basically income minus expenses gives you NOI. That's what we call net cash flow in our world. Same thing as EBITDA if you're used to business economics. Then we subtract the depreciation. That usually results in a taxable loss, even though the property was profitable from a cash flow standpoint. So the net cash flow, that gets distributed to you. The taxable income or loss, that is reported to you on your Schedule K-1 tax form. You take that K-1 information, put it on your personal tax return, And as long as you meet certain requirements, you can use those real estate losses to offset other income, as long as you meet those requirements. So to put it all together, cash flow, it's the drip, but it actually drives the entire investment because it drives appreciation. In our world, we get a multiple typically of 17 to 21 times cash flow. So our valuation is about 17 to 21 times whatever the cash flow is for the property. I'm going to go through a super simplified example. I'm going to ignore transaction costs. I'm just illustrating a concept here. So in our world, maybe we buy a 100-unit property, maybe we paid $100,000 for it per unit. That's a $10 million property. In today's market, not uncommon at all to have a $4 million down payment on that deal. And let's say our business plan over 5 years is to raise rents $300. It might not come tomorrow, but over that 5 year period, we've done the homework and we are very certain that we can get $300 in upside. So now fast forward the clock. We're going to figure out how much this thing went up in value. Fast forward the clock 5 years. You've got 100 units times $300 more in rent increases times 12 months. That means your cash flow, your new cash flow, is $360,000 for a 12-month period. Now, here's the gold, right? When you take that $360,000 and you divide that by what we call a cap rate, it's just the inverse of a multiple. Right now, it's not unusual for properties to trade in the 5 to 6% cap rate range. I'm going to use 6% for this illustration. That means when we take $360,000 and divide it by a six cap, we get about $6 million in new value. Now you can see why I tell you that the appreciation is where the money is in this game. So remember, we bought this thing for 10. If it's worth 6 million more, we sold it 5 years later for $16 million. We got a total of 10 million back. We got our $4 million down payment and we got our $6 million profit. Remember, our down payment was only 4 million. So that gross return is 150%. If we just do a crude divide by five, because it took us 5 years to get there, that's a 30% average annual return on investment. Now, that's not our IRR. I'm sure many of you know what IRR is. That takes into time value of money, which would just be a little bit less because we're waiting to the end of our deal to get most of the profit on this deal. So when I look at multifamily, this is why I love multifamily. There's just very few investments that can do everything that real estate does, especially multifamily. You got cash flow, the underlying asset can appreciate. Now, there's no guarantee, you know that. Tax benefits, these losses that I talked about, and the potential to defer gain. You actually get leverage returns. If you just think about using 50% leverage on a property, that actually ends up doubling the multiple. So it's not 17 to 21, what that's like 34 to 42 times. Those are really high multiples. This is real. We do this every day. It happens every day in this business. The business itself is pretty easy to understand. I mean, I feel like it's really hard to make it go away. Everybody needs a place to live. I can't figure out how to make it go away. If it does, we probably are not worried about money at that point. But it is not a get rich quick plan. It just isn't. Over the long run, it does have the potential to make you very, very wealthy. That's why almost every single wealthy person has a significant real estate investment. Now, why now? This is the most important part of this presentation. Super important. Debt maturities. Now, about $330 billion of multifamily debt is expected to mature in 26 and 27. That's this year and next year. About 85% of that was originated by other sources other than Freddie or Fannie. So they would be bridge lenders, those are debt funds, banks, and CMBS lenders. Most of those were originated back in 2021. Rewind the clock, that was when everybody had to get into real estate. Well, now these guys, these loans have matured. They need to refinance or sell, but it's difficult because interest rates are considerably higher. We're going to talk about that in a second. Prices are down because of that. And some of these properties, they just aren't performing as well as they were expected to. So a lot of these guys right now are having trouble. They either face cash in refinance scenarios, which means they can refinance, but they got to pay down the mortgage, which many times they just don't have the equity. They can't go to their partners and say, "Hey, we need another 5 million bucks to pay down this mortgage." And if they did, the partners would likely say no. So these debt maturities are creating challenges for people right now. Number two, interest rates. I probably don't need to spend a lot of time on this. You guys are all astute investors here. I mean, the change in interest rates has been dramatic. We pay particular attention to the 10-year Treasury. I actually like the 7-year, but the 10-year is fine. You can see here, I'll get out my little annotator just to make this a little easier. It went from an average of 1.45 to 423, right? Well, here's the deal. Real estate is highly capital intensive, and so you can't afford to pay as much when rates, the cost of capital is considerably higher. So really important thing that rates have done to us and to the industry. Builders, this is a pile-on kind of concept here. Builders have delivered the largest number of units since the 1980s. Specifically, I think the peak was 86, 87. As a result, most rents in most of these markets have been flat because you got builders dumping tons of inventory, and it just takes a minute to absorb all that inventory. Builders lease ups are taking longer, they're discounting more, and they are not hitting their projected rents. That's really important because interest rates on their construction loans, those are variable rate loans. So if you're hung out there for longer than you expected, rates went up when you didn't expect them to, you've got a really big problem. If you're a builder, most of these guys need to sell. I'm going to show you a couple deals that we did buy from builders that had that very situation. They don't want to cash in refinance because they don't have the capital, and they don't want to operate properties because they're not operators. Now, the good news is that new multifamily starts are down 50% nationally. We do a lot in Florida, 70% in Florida since the peak of 24 and 25. That's really, really important because this inventory glut is not going to last. So that in the existing inventory in the market is in fact being absorbed. It's keeping rents flat. This means that at some point here, 20, probably late 26, 27, 28, we don't have any starts. Our starts are very, very low. So that means that it's going to more than catch up, and it's going to become an owner's market where we're going to be able to get back to just simple organic rent growth because we don't have all this new inventory in every market that's trying to be absorbed. So, when you think about it, buy now because there's a lot of people that need to sell because of all the problems I just described. Now, institutions, let's talk about on the buyer side. Institutions, they're not buying right now. They're still dealing with their problem properties that they bought in 21, 22, and variable rate debt. That always amazes me why they would do that. They're very smart people, but they did. That means with them out of the market, guys like us, we can buy really high quality assets at historically high cap rates. When the institutions do start buying, their cap rates are going to go down in the markets because they have a different capital stack and return requirements. They could be more patient than we can. Our investors want cash flow, and rightly so. So we have institutions out of the market. In addition, there are way fewer buyers than there were back in 21, 22. A lot of deals are falling out of contract because inexperienced sponsors cannot raise the funds. They just can't. Investors now are more careful about how they vet sponsors, which they should be. I'm thrilled for that. And many investors actually, they've had some risk capital from those early investments that they made. So they're being much more careful about who they invest with. So strong buyers are getting huge, incredible deals on really high quality assets. So if a buyer has cash in the bank, they have a massive advantage. That is not a newsflash. That happens all the time. Newsflash, we have cash in the bank. That's what we've been doing. This makes us an extremely strong buyer. Because of that, we're getting incredible properties at really good prices. This is how generational wealth is created. I will tell you the last time the market looked this good, it was back 08, 09. Many of you remember that. I wasn't in a position to buy. I'm telling you, there's no chance I'm missing this opportunity. So I would encourage you that if you're interested in multifamily, take advantage of the opportunity to invest with me, my team, in our Fund 6. So I've actually tried to make this easy as I can. If you invest in Fund 6 before we identify our first deal for this fund, remember, we raise the money up front and then we use that money to buy the deal. If you invest with us prior to us finding that first deal, I will pay for your first year asset management fee. We only charge 1%. It's very, very low fee, but I'll pay it for you for the first year. Why do I do that? Because I told you I'm here for the appreciation. That's where the money is. I don't really care about the fees. So let me give you a good example as to what we buy. This is an example of what we bought. There's 102 units, St. Pete, Florida. This property we built from the or excuse me, we bought it from the builder. The same scenario that I just laid out was their scenario. Clearly, this is not a distressed property. This property, we've actually been able to raise rents already since we bought it, I think it was mid 24. When rents have been flat generally in the Tampa St. Pete market, we've already raised rents here $100 across the board on average. So most people in this business, they go find the deal and then they raise the money. You know that as a syndication. We flip this thing around. We're a private equity fund. We raise the money first and then use that strength to negotiate deals like this. We bought this deal for just under a 6 cap. If you know the Tampa, Florida market, there's no way we should have been able to buy this for a 6 cap. So we use our strength, our experience, and our reputation in the market, that can't be understated, to get deals closed that a lot of others can't. We always plan to add value. I mentioned that earlier, in every single deal. And when we do that, that allows us to either refinance or sell the property when we're able to complete our business plan and you got the benefits. All of our funds always target the same. We're always targeting a mid-teens annual rate of return. We're looking at an equity multiple of 2x. That's basically trying to double your money in 5 years. And our target cash on cash return is 6%. See how we doing on time here. It looks like we're good. We tend to hold 4 to 6 years. What we're looking for is 75 to 200 units, and we stay at the higher end of the quality spectrum, A to B plus assets, like some of the properties that I've shown you. By the way, this is another property. This is the last property we closed, Allure, on Enterprise, 130 units in DeBerry, Florida. I mean, it's absolutely gorgeous property. All right, back to our fund. So our waterfall, our profit split, I keep things as simple as I can possibly keep them. Basically, on the large capital events, so a sell or a refinance, we return all your money. Then it's an 80-20 split. On the operating cash flow distributions, it's a straight 80-20 split. Those 80-20 split, those obviously it's the drip. All right, why would you want to invest in us? We've been doing this for 28 years. We've acquired 20 properties. 14 of those have gone full cycle. That means we bought, we operated, and we sold. Our entire portfolio is on our track record is on our website. If you want to go see it, kripartners.com. And that entire track record, all 28 years of it, was vetted by a third-party company called Veravest. So what I put on our website is a screenshot of our returns on their website. Then you can link through to their website. They calculated the returns. I did not. I felt that was important so you could see that somebody really did look under the hood. Our senior management teams manage more than 16,000 units. Why is that important? Because when you buy a business, you need to know how to run it, and we do. We've got about 450 investors that invest with us so far. We've raised about 60 million bucks and distributed $27 million. I just heard from our controller, we distributed almost another 550,000 just yesterday to our investors. So a quick look at a couple of our deals here that we've, well, this one we actually still own. This is Arbors at Garden Grove in Winter Haven, Florida, 90 units, not a massive property. We bought it in 2016. We raised 2.2 million to do this deal. Now, since then, we've returned everybody's 2.2 million. We've distributed another 1.8 million. So they got, they put in 2.2, they've gotten back 4 million. The property still has $10 million of equity in it. They still get quarterly cash flow distributions. And I think they'd probably kill me if I sold this thing because they took that 4 million out, and I am sure they've invested it again and again and again. That's how you create massive wealth in this business. Belle Reeve Club Apartments. This is a property that we've actually sold 104 units in Jacksonville. And by the way, I'm just going backwards in time. I didn't cherry pick the properties that I'm showing you. So we bought that for about 7.5 million. Sold it 3.5 years later for 13 million. And that means that our investor annual ROI is about 22%. What does that really mean? That really means that if you gave us 100 grand over that period, we gave you back 177. That's the simplest way that I can talk about returns, right? Because that just makes sense. Whispering Oak, 75 units, Orange City. This is not far from that Allure deal that I just showed you. We bought it for 4.9 million, sold it for 8 million after 2 years and 1 month. Actually, I rounded down. If you gave us 100 grand in that deal, you would have gotten back 172. Why were we able to do that? Because we moved rents. Every single time in our world, we're able to move rents, and that's how we make money in this business. And then finally, Coachman Club Apartments. Looks like I'm doing okay on time. 72 units in Clearwater. We bought it for 6 million, sold it after 2.5 years for 8.2. We moved rents a lot in this deal, $340 a month. So if you gave us 100 over that 3.5 year period, you got back 175, which was about a 30% annual return. So those are some real deals that we've actually bought, ran, and sold. And again, these results are on our website. You're welcome to take a look at that. Now, if you're interested in talking to our team about what we do, how we do it, getting into Fund 6, taking advantage of that offer for me to pay your asset management fee for the first year, call or text money to 216-290-1707. By the way, this is Allure on Enterprise. This is the leasing office that you're looking at right there. One other thing I do want to offer to you, and that is we do once a month something called our Real Deal Investor Update. It's where I go through every one of our properties, including Allure, including Levi, and all the other properties that we have. And I lay it out exactly what's happening, what the performance looks like, what's our occupancy, how many leasing leads we get, what's our insurance situation, all that kind of stuff. I do that once a month. We have our next Real Deal coming up next Wednesday, February 4th, 7 p.m. Eastern. If you're interested, all you need to go do is go to kripartners.com/real deal, REALDEAL, and just register. It's a free webinar. And you don't even have to participate. But what we do is after I share all of this information on our portfolio, it's open Q&A. And I use it as a way to really have one-on-one conversations publicly with our investors to make sure that I can be as transparent as possible. And we typically get a couple hundred people that show up for these webinars with lots of really, really good questions. So if you're really curious about our portfolio and what we do and how we do it and have a chance for some good Q&A, come to that webinar, kripartners.com/real deal, or call or text money to 216-290-1707. It'll be a one-on-one conversation with a member of our client success team and that conversation is really going to focus on what you are trying to do with your investments. And we want to make sure that what we're trying to do kind of matches what you are trying to do. Charlotte, I got 1 minute left, I think, or about 6 minutes left. If we have any questions, I'm happy to take them.
Absolutely. And yes, we do have a few minutes left here. I have a question in the chat from Mr. Castleman asking, how concerned are you about mega storms in Florida and expensive insurance affecting the fund's returns?
Yeah, excellent question. Actually, the insurance runs in cycles in Florida. The peak insurance cost was probably a year and a half ago. We've actually had insurance rates come down the last couple of years, like 30% each year. I mean, it's really it's because of the insurance cycle. What happens is insurance companies beat each other up, prices go down, then they lose money, then they leave the market, then the capacity shrinks, then the prices go up, then everybody comes back in the market. It's literally a cycle, and it's been going on for almost 30 years. So we project, insurance increases. We just do. We expect that they may go up, and we need to be able to handle those. The only way to really protect yourself against any sort of expense in our world is to make sure that we don't get FOMO. We are very, very disciplined about what we buy, and we make absolutely certain that we are very convinced there is upside in rents. Because if you have more income coming in, that's how you cover yourself against insurance increases. That's how you cover yourself about against any sort of expense spike that you weren't prepared for. Now, as it relates to storms, I mean, we have insurance to cover storms. What we don't do, we don't buy on the beach. We don't do that because that's too risky for us. So we manage what type of property we buy, the age of the property, its proximity to the coast, and that's how we manage that risk. So excellent question, Mr. Castle.
Well, thank you, Ken. I have another one here in the chat from Jake Gelski asking if retirement funds are allowed.
Yeah, great question, Mr. Gelski. So yes, about a third of our investors actually invest through their IRAs or 401ks. That most people don't think about that. It's really easy to do. All you need to do is transfer your IRA to what's called a self-directed IRA. Super easy to do. We can help you do that. A third of our investors do it because the reality of it is, here's why I love it. Real estate is generally a longer term investment, just like your IRA. I love that matching that we get with IRA money. And most people have most of their wealth in their 401ks and IRAs. So I attribute that to that. That's probably why about a third of our investors use IRAs to invest. So great question.
Thank you, Ken. And I had a couple people just wondering if you could go over the tax benefits one more time.
Yeah. So every quarter we distribute cash flow to our investors. So let me just tell you what happens at the end of the year. We just went through this. At the end of the year, we send our P&L to our CPA firm. And that shows that we made money because we did, and we distributed money to our investors. So they call us and they say, okay, we've calculated the depreciation. And Kim, who's our controller, Kim, we want you to book the depreciation entry. It is so large because of all of the reasons that I talked about on the big, beautiful bill, that those losses, that entry turns it into a tax loss. The tax loss is what actually goes on your K-1 and then gets pushed through to your personal tax return. So the benefit is you're getting this cash flow that you don't have to pay tax on at the time. Now, if you're a real estate professional, you got to meet some certain requirements. But if you are, you actually can use those losses to offset other income, W-2 income, business income, all that other kind of stuff. So that's one of the tax. There's so many other tax benefits. I mean, when you sell, there's going to be capital gains, right? I like taking ordinary income deductions and trading them for capital gains rates on the sale. I don't have enough time to really go into the nitty-gritty on that, but if you come to a Real Deal webinar, I can really walk you through that process in more detail because I won't be time restricted.
Thank you, Ken. And I had a question from Joe here asking if there are truly a lot of distressed sellers in the market right now.
Yes, absolutely there are. Yeah, there are. There are 85% of the loans back in 21, 22. They're 5-year, mostly bridge loans, and they're coming due. They're due. And if you refinance with that same bridge lender, maybe the rate was 4, it's now 8. I mean, that's crazy. That's just a ton. So yes, the Levi sellers, they had to sell. Their construction loan interest rate was considerably higher than they wanted it to be. The Allure seller, very similar situation. And so, yeah, they're everywhere. They haven't shown themselves until early 26 because I mean, 21 plus 5, right? 21 was when they took the loan out. 5-year loan equals 26. This is happening right now. I probably got 10 deals in the last 10 days, and that's 10 more than I got for the last couple months of 25. Is that's just what happens in the fourth quarter. So yeah, they're out there for sure.
Fantastic. Well, I think we may have time for one last question here
Okay.
from Mike. He's just wondering if you can tell us about your track record.
Yeah, so our track record, it is 20 deals. Go to our website, kripartners.com, and take a look at our website or our portfolio there. What you're going to see is the first 10 years, I was mostly in Cleveland. Didn't raise a lot. I don't think I raised any money from outside investors. And after 10 years, I decided I can make money in Cleveland. It's awesome, but boy, what if we actually bought in markets where people want to live? That's always funny, a joke, sort of, but it worked because for the last, what, 18 years, we bought in Florida, and there's no way I could have done in Cleveland what we do in Florida. So go to that website and look. The record is vetted by Verivest. Verivest is a third-party firm. They don't actually do this anymore, but I mean, I had to send them 28 years of tax returns and settlement statements and operating agreements. I mean, it was horrible to go through, but it was really important to me that when an investor looked at our track record, they were comfortable that it just wasn't me making stuff up and throwing it on the internet. It was actually vetted by them, and you can see the results of their calculations of my returns on their website.
Well, Ken, thank you so much for joining us and for getting some answers out there for our audience. I know they appreciate it. It's been a pleasure having you on the show today.
Thank you so much, Charlotte, for having me.
Absolutely. The pleasure's all ours. And to our live audience, thank you as well for joining us. Do stay tuned as we have more in store for you in this Money Show Virtual Expo. As always, I hope you all have a wonderful rest of your day. Take care.